Let's talk about one of our companies here, Kraft Heinz, KHC in the packaged foods industry. They're in the news a lot lately. Chase will talk more about that, but let's look at the numbers. Short on the float is about 6%. Institutional owned 59.4%. I believe Warren Buffett, Chase will talk more about this, does own about 27% of the stock. Kraft Heinz price earnings, nothing there. They have no earnings over the last 12 months. Industry at 16.3. Price of sales 1.3 versus 0.4. Price to book value 0.8 versus 1.9. And then price of cash flow is expensive for Kraft Heinz 7.5 versus 3.7. The pay ratio going forward, terrible. 142 versus 123. Usually we like these around 2 or 3, not 142. We do see in the earnings, no growth on the earnings over the last year, even 5 years. Sales for last year down 3.8%. The industry was actually up 30.1%. The 5-year estimated growth from the analyst, only 0.1%. Industry 2%. Kraft Heinz does pay a nice dividend of 5.9%, but no payout ratio because they have no earnings. It does take 55% of their free cash flow to pay that dividend out. We do send the balance sheet. Current ratio 1.1 versus 1.5. That's okay. Debt is in check. 0.5 versus 0.8. Net profit margin. This is terrible. A negative 20.8% versus a positive 5.2% for the industry. And then return on equity, a negative 12.7 versus 12. Their free cash flow is actually pretty good, though, $3.5 billion, about double the industry at $1.4 billion. Chase, what do you got?
Yeah, so current price here for Kraft Heinz, again, their ticker symbol is KHC. It's $27.29. The 52-week range, the low here is $25.44 and the high $36.31. I mean, the 10-year return on this is just atrocious. It's down 63.5%. I was going to see what it was with dividends.
It was down 41.3.
I mean, it helped cut off about 20-ish% of that. So the reason that's important is about 10 years ago is when Warren Buffett and then a private equity group, 3G Capital, had the idea to merge these two companies, Kraft and Heinz, together. And obviously that was not a great idea as it has not performed well. But now the big news is they are splitting these companies once again, and they're not really divulging what the names of those companies are going to be. As one company will hold Heinz Philadelphia and Kraft Mac and Cheese. That's about 75% of the sales came from sauces, spreads, and seasonings. And then the other business is going to be kind of more of a scaled portfolio of North American staples, which would include items such as Oscar Mayer, Kraft Singles, and Lunchables. I would assume that maybe the sauces company would get a higher multiple than the staple business. Yeah. So we'll have to see what happens here. But I know Buffett was not a fan of this announcement.
You know, and it shows what a long-term investor he is. He's down, we figured it's more than I thought it was, 10-year return down a negative 41%. But he still thinks it should continue on. I'm not sure why, but he likes the business. He likes the idea of the business. But he is against that split up. And I read some things, too, that it is not always the best thing to do for companies. It doesn't always pan out.
It doesn't always pan out to merge or to split off?
Spin off.
Yeah.
Split. Yeah.
I mean, we'll see. I mean, because the value is still here. I mean, the company has a great forward PE, go out to December 2026, estimated earnings per share, $2.67. Estimated sell would be $44.32. And the interesting thing is, again, the value's there, but generally when you announce that split, you get a bump. Yeah. In this case, the stock fell. I think it was like 7%.
Yeah, it did.
Because I think of Buffett's discomfort with it.
Yeah.
But the concern is, what if he starts selling shares, owning 27%? That could cause the stock to fall dramatically.
I don't think he'll do that. But